Money Show is delighted to welcome back Peter Schiff, Chief Economist and Global Strategist of Euro-Pacific Capital. Mr. Schiff has been quoted hundreds of times in leading news outlets around the world and regularly appears on business news channels worldwide. Peter, thank you so much for joining us. The floor is yours.
Oh, thanks for providing me with this floor. And so I'm going to talk today about gold, and more specifically, gold's failure to deliver on the promise or the expectations probably that a lot of people had who currently own gold, or maybe more importantly, people who own gold stocks who were anticipating a gold rally. And one of the reasons that a lot of people own gold is inflation. We're buying gold as a hedge against inflation. And now we've seen some of the worst inflation numbers we've really seen since the early 1980s or the 1970s. Yet the price of gold is kind of hovering around 1800, a little bit below as I'm speaking. And gold stocks have actually been among the worst performers. In fact, technically in bear markets, having to pull back at least 20% from their recent highs. In fact, if you look at many of the stocks like the GDXJ, which is an index of junior gold mining stocks, that index has been making 52-week lows, although it's not at a 52-week low today, but it has been hitting those lows, despite the fact that those of us who were betting on more inflation bet right. We have more inflation. It's just that if you place that bet through gold stocks, so far you haven't been paid. And the reason for that, I think, is a bit ironic. It's almost that gold, rather than being a beneficiary of inflation, is actually suffering. It's a casualty of inflation. Higher inflation, paradoxically, is actually bad for gold, and in particular, gold mining stocks, more so than the metal itself. And the question is, why is that? And how much longer is that paradox likely to continue? Because, if you look at the inflation numbers, we got inflation numbers this morning that were part of the GDP numbers. And the year-over-year increase is better than 6%. And that is the highest annual rate of price increases measured by government measures since, again, the early 1980s. And if we still measured inflation today the way we measured it back then, the number would be much worse. I mean, just take, for example, rent. If we actually used real rents, the rents that people are paying, those of us who still are paying rent, who are renting, if you look at what's actually being paid versus what the government pretends that people pay when they use owner's equivalent rent, which we use today, but which wasn't in use in the early 1980s, we would have an annual inflation rate right now north of 10%. In fact, it's possible that the last 12 months have seen a bigger increase in consumer prices than in any year during the 1970s, which is known for being the year of inflation. In fact, the 1970s really got started when inflation first peaked above 4%. And that initial move above 4% was what led Nixon to impose temporary wage and price controls, which of course did not work because wage and price controls go after the symptom of inflation, rising prices, rather than the cause, which is the government or the Federal Reserve printing money. But the point is that the inflation that the government will admit to today is already 50% higher than what was so bad in the early 1970s that it caused Richard Nixon to panic and go for wage and price controls. So what was an alarming rate of inflation in the early 1970s is now being brushed aside today, not only by the Federal Reserve, but also by investors. Investors don't believe that the high inflation numbers that we're seeing today are sustainable. In fact, the watchword is transitory. Everybody thinks that this is a transitory increase in consumer prices, not a permanent increase. and therefore they're not motivated to move into an inflation hedge, because you don't need to hedge transitory inflation. And in fact, if inflation is not transitory on its own, the markets expect that the Fed will make the inflation transitory, because Fed officials have repeatedly assured the markets with words that they will do that they have the tools to somehow make sure that inflation stays anchored at 2%, even though they're going to allow it to slightly exceed 2% in the short term. Over the long run, they are determined, and they are going to use their tools to make sure that inflation stays at around 2%. And it's the anticipation of using those tools that is weighing so heavily on gold and on gold mining stocks, because there is an old Wall Street adage: you don't fight the Fed. And what happens when the Fed is tightening monetary policy? Well, that's supposedly good for the dollar and bearish for gold. And if it's bearish for gold, it's even more bearish for gold stocks, which represent the present value of their future earnings. And if you expect gold prices to be even lower in the future than it is now due to the Fed tightening, well, you would see that in today's gold price, in today's gold stock price, even if you wouldn't see it in today's gold price, because the stocks are forward looking, whereas the spot gold price is not. It's just looking at what is the price today. But why do people believe Fed policy is going to be so dollar supportive? Why do they think it is going to hurt gold? Well, because traditionally, that's what happens when the Fed tightens. And so everybody assumes that this tightening cycle will be the same as all the prior tightening cycles, without recognizing the huge difference between this cycle and the ones in the past. Because it's possible that this cycle will consist entirely of talk. It may not consist at all of action. And talking about tightening monetary policy is not the same thing as actually tightening it. But even if we do begin to tighten, the way that tightening is going to be rolled out is going to be simply through a reduction of the amount of quantitative easing that the Federal Reserve is currently doing. And they're referring to this reduction as a taper. And it's all this taper talk that has been talking down the price of gold, and therefore gold stocks, and helping to talk up the dollar. But if you understand what the Fed is actually talking about doing, they're not talking about shrinking the money supply. They're not talking about reducing the size of their balance sheet. They're simply talking about increasing their balance sheet at a slower pace in the future than they're increasing it now. In other words, they're committing to creating less inflation in the future than they're creating right now, but they're still committing to creating more inflation. Inflation is an expansion of the money supply. And even if you slow down the rate by which you're expanding the money supply, you are still adding to the inflationary problem that exists. In other words, the Fed is not talking about putting out a fire. The Fed is talking about putting less kindling on the fire, or throwing less gasoline on the fire. So they're not going to put out the fire. They're saying, look, we're just not going to pour as much gasoline on the fire as we're pouring on the fire right now. That is not tightening monetary policy. If you have an extremely loose monetary policy, and all you're going to do is potentially make it slightly less loose, that doesn't qualify as tight money. And it's tight money that historically has been bullish for the dollar and bearish for gold. Not just, being less loose than you were at one time. And of course, one of the things the Fed is talking about doing, which it may in fact never do at all, is raising interest rates. Because you have to remember that throughout the entire period of the taper, where the Fed continues to do quantitative easing on a monthly basis, but reduces the amount of QE it does on a monthly basis, but during the entire process, interest rates are going to remain stuck at zero. And all they're talking about doing is at some point in the future, after they finally ended quantitative easing and the Federal Reserve's balance sheet is substantially larger than it is right now, because between today and the time they finally end QE, if they ever get to that point, they will have bought a lot more government bonds and mortgages. So there'll be a much larger balance sheet. What they're saying is at some point, we're going to raise rates, but they're at zero. Where are they going to raise them? 0.5%, 1%. Look how high the inflation rate already is. Real interest rates have never been more negative than they are right now. If you've got interest rates at zero and the official inflation rate is 6%, unofficially it's much higher than that. But if you're at 6% and your interest rates are at zero, the yield is negative 6% because you have 6% inflation and you're getting zero interest. So none of what you lose to inflation is being returned to you through interest. So even though the nominal rate is zero, the real rate is negative 6. Even if the rate went from negative 6 to negative 5 or negative 4, that is still extremely bullish for gold. What you would need to have an environment that is negative for gold would be high real interest rates, not negative interest rates that are less negative. But the reality is interest rates are likely to go more negative because the 6% inflation that we're experiencing now is not the ceiling. It's more likely the floor. We're going higher from here because the Fed is doing nothing to actually fight inflation. Simply talking about tapering and even tapering your QE program is not going to fight that kind of inflation. You're not going to put out a 5-alarm fire, which is really what we've got, with a water pistol, and they don't even have that. What they're going to be doing is they're going to be accommodating an increase in inflation as they're pretending to fight it. Inflation is going to be winning because the numbers are going to get bigger and bigger. And so I think that everybody who is selling gold or selling gold stocks because they assume that what we're going to experience is a normal tightening cycle still doesn't get the bind that the Fed is in, and they still haven't figured out the way this game works, because whenever the Fed tightens, whether it actually tightens or just pretends to tighten, but the minute they start doing that, they sow the seeds for the next easing cycle. And each tightening cycle becomes smaller and smaller, and each easing cycle becomes bigger and bigger. If you recall what I was saying during money shows when we first launched quantitative easing, when the Fed announced that it was going to end QE, and eventually it was supposed to shrink its balance sheet back down to where it was before the financial crisis, not only did I say that was impossible, not only did I say that if the Fed ever tried to taper, it would have to abort the mission before it was completed and run the balance sheet back up, because that's exactly what it did. But I said when the Fed was forced to do QE4 as a result of the next economic downturn, that QE4 would be bigger than QE 1, 2, and 3 combined. And that again was an accurate prediction, because the Fed's balance sheet is now $8.5 trillion, and the highest it got after QE1, after QE3 was $4.5 trillion, and it was about $800 billion before they started QE. So what the amount of QE that we've already done, forgetting about the amount that we're going to do between now and a successful conclusion of the taper program, it may be triple, right? QE4 could be 3 times the size as QE1, 2, and 3 combined, not double. And even if the Fed succeeds in ending QE this time, when they have to start it up again, when they have to do QE5, it's going to be at least double, if not triple or more, what they just did in QE4. And just like the easing cycles get progressively more easy, the tightening cycles get progressively less tight. Where was the Fed able to successfully raise interest rates too, following the bursting of the dot-com bubble. When they lowered interest rates to 1%, and then when they tried to normalize them, they actually got back up to above 5%. But then when we had the financial crisis and the Fed brought interest rates down to back down to zero, how high could they get them? The highest they got was about what, 2.25 before the wheels fell off the bus in the fourth quarter of 2018. And then we went right back down to zero. But in the meantime, when the Fed went to zero following the financial crisis, that wasn't low enough. They needed quantitative easing on top of 0% interest rates because the bubble was so big and the hangover so big when it popped that 0% wasn't enough. The Fed needed quantitative easing in addition to 0%. But in the prior cycle, not only wasn't quantitative easing needed at all, but we didn't even have to take rates to zero. 1% was low enough. But because of the enormity of the bubble that the Fed inflated with 1% interest rates, when that bubble popped, 0% wasn't low enough. We needed 0% and QE 1, 2, and 3. Well, when that bubble popped following COVID, even 0% wasn't enough. So we needed QE 4 to be even bigger than QE 1, 2, and 3. And we needed to expand it into other assets like junk bonds, which is also part of what the government is doing. And not only did we have QE for Wall Street, but this time we got QE for Main Street, right? The economy is so screwed up because of all the debt and all the leverage that this time the government is sending out money directly to the people, right? We're getting these government supplemental unemployment programs. We're getting rental assistance. We got the PPP, the forgivable loans. We didn't have any of this stuff in the prior Great Recession, but all this stuff is happening now because the economy is in a much weaker position as a result of all these years of stimulus. In fact, even listening today, because they just started the Jackson Hole conference today, tomorrow we're going to hear from Chair Powell, and he's, of course, going to talk about taper. I think we had Bullard. I was listening to him interviewed today on television, and I forget another Fed guy that was on there. Of course, they're all talking about taper, and the market reacts to this. Even though they're not actually doing anything, they're simply talking about doing stuff. But what I'm noticing among these Fed governors is they are basically applauding the U.S. government for the fiscal policies that it pursued following COVID. And they're saying that the government did an excellent job in helping to replace the demand that went away due to COVID. That was not the correct decision. That was a mistake. The government was wrong to replace that demand, and the Fed was wrong to monetize those efforts in order to accommodate all that extra spending. Now, the reason that it was wrong, because everybody says, demand was down during COVID. Yes, and demand should have been down during COVID, and we should have allowed the demand to stay down. Why? Why was demand down? Well, people weren't going to work. People weren't producing things. They weren't helping to build products. They weren't helping to supply services. So there were not nearly as many goods and services available in the market. So if supply goes down, demand needs to go down. If demand stays the same and supply goes down, well, then the prices are going to go up. But the government made it worse. In the face of falling supply, they added demand. So they fueled this inflationary cocktail where we saw falling supply, rising demand, the worst policy mistake they could have made, worse than even the big mistakes they made in the past. And that's why this is massive inflation. But it's not just the consequences of the inflation that we created after the pandemic. It's all the years of the inflation that was created before the pandemic. All of these inflation chickens are just now starting to come home to roost. And a lot of the earlier inflation that we created showed up more on Wall Street, mainly in asset prices. Now it's back on Main Street in goods prices. You're also seeing it in housing prices, right? That's back on Main Street. Main Street, there's a lot of houses on that street, but we're seeing those prices go up as well as the cost of renting those places and the cost of maintaining them, utility rates, insurance costs, everything is going through the roof. And this is just the beginning of this inflation. And I think it is going to make the 1970s, look tame in comparison. It's going to be much higher inflation, even the way we measure it, even with the phony CPI that we use that barely captures the true rate at which prices are rising. I still think we're going to see readings in the double digits, but that means the actual rate of inflation will be higher. Maybe the first digit will be a 2, not a 1 on an annual basis, but we are talking about some serious inflation. The Fed cannot fight this inflation. The markets have got that wrong. In fact, I don't even think the Fed is going to try to fight it. I think the Fed knows that if it fights inflation, it's going to lose. So it's not even going to fight. Now, it will bluff. It will talk a good game. So it never actually has to get in the ring and get knocked out. So it's going to pretend that it's got these tools and it's going to use them, but it can't use them. If you remember what it took to end the inflation of the 1970s, and again, the inflation we're about to experience is going to be worse. It's already starting off worse early in this decade than it started early in the 1970s. But what happened in 1980 to finally break the back of inflation and to restore confidence in a sinking dollar and to break a gold bull market where the price of gold went from $35 an ounce to $850. What it took to bring that to an end was the combination of Paul Volcker with 20% interest rates and Ronald Reagan with government is the problem, the free market is the solution. We are nowhere near that type of combination today. We have the polar opposite of Volcker in Powell and maybe the opposite of Reagan in Biden. So we're going to have loose money. We're going to have bigger government, bigger deficits. And even if Powell wanted to allow interest rates to rise to 20%, how's he going to do it? We saw what happened a few years ago when they raised them to 2.5%. Everything collapsed. Well, if the economy couldn't withstand 2.5% then, it certainly can't withstand it now because the economy is far more levered up today than it was in 2018. The U.S. government has much more debt. Corporations have much more debt. Americans have much more debt. The markets are far more overvalued. Stock market's a bigger bubble. The real estate market's a bigger bubble. So we're far more vulnerable to a rise in interest rates than we were then. And look how much damage a small rise did then. Imagine what an even bigger rise, a rise that's actually high enough to fight inflation would do. That's why they're not going to do it. So the fact that the markets are worried that the Fed is going to fight inflation with an aggressive or any type of monetary policy that somehow is going to be negative for gold and positive for the dollar is completely wrong. And I think that relatively soon, the markets are going to start to price in the fact that they've got it wrong, that the Fed is not going to be able to fight inflation, that even if it tried to fight inflation, it would lose, and therefore it won't. And so the Fed is going to go from assuring the markets that it will fight inflation to assuring the markets that we don't have to worry about inflation, that inflation is a good thing, that inflation is necessary part of prosperity and economic growth, that it's a trade-off that's worth making because jobs are important, because economic growth is important, because all these government programs are important. And we're not going to sacrifice all that over some number. We don't have to keep inflation as at 2%. All right, 3%. Okay, 4%, 5%. That's not that bad. That's what they're going to try to tell us. At the same time, I'm sure they will probably go back to the drawing board on the CPI and figure out a way to make the number even smaller so that they can cover up the results of their inflation. And again, you got to remember, inflation is a tax. That's really what it boils down to, is a tax, because the government has two ways of paying for stuff. It can do it honestly through taxation. It can also legitimately borrow money, but borrowing money simply obligates future taxpayers to pay higher taxes. So that's also taxation. But the other way that government can get money, if they don't want to do it honestly, is they can print it, or they can ask the Federal Reserve to print it. Or the way we do it, the US government sells treasuries, and then the Federal Reserve buys them in the marketplace, preventing interest rates from going up and funding all this government spending. But now the government is not spending the money it collected in taxes, it's spending the money the Fed printed. But that doesn't mean taxpayers are off the hook. That doesn't mean we get a bunch of government for nothing just because the Fed printed the money to pay for it instead of us sending our money to Washington. Because when the Fed prints money and gives it to the government, the Fed is effectively stealing our purchasing power. They're making all the dollars that we hold less valuable. So the price of everything goes up as a result. And that increase in price, which we call inflation, which actually is the result of inflation, amounts to a tax. So the way the government taxes us, instead of taking our money, they take our purchasing power. So the result is the same. If I have, $10,000 and the government takes away $1,000 in taxes, now I can only buy $9,000 worth of stuff. Well, if they leave me with $10,000 and print a bunch of money, and now prices go up by 10%, and now I can buy less stuff, I buy 10% fewer goods because the price of everything went up 10%, I'm in exactly the same predicament had the government been honest and taken my money. Instead, they were dishonest and took my purchasing power, because the money they printed, they gave it to somebody else, and somebody else spent that money and they bought the products that I can no longer afford. And this is what's going to be going on throughout the economy, is inflation tax is going to get higher and higher. And I think soon the people who are selling gold because they expect the Fed to win a fight against inflation will start buying gold because they realize that they're not going to fight and inflation is going to win, and it's going to win this fight by knockout. And what's going to be even more impacted than gold is going to be the gold mining stocks, because they're already so far ahead of gold on the downside. The gold stocks are assuming that the gold price is going to fall as a result of all this tightening that they have now discounted into the market. When they have to reverse those expectations, when they have to realize that instead of shrinking its asset purchase program, it's going to blow it out to a whole new level. Right now, we're at 120,000 a month, 120 billion a month, rather, in purchases. And even if the Fed manages to taper that, maybe down to 90 billion or 80 billion, whatever it is. Remember, the initial QE for QE3 was 85 billion. I don't even know if we can taper QE4 back down to the level of QE3 without everything falling apart. But to whatever degree, to whatever level the Fed succeeds in tapering QE, they're going to ramp it back up again. And so they're going to be at 150 billion. They're going to be at 200 billion. If we get this $1.2 trillion infrastructure passed through Congress, if we get this other $3.5 trillion spending bill, we've already had additional spending coming from Biden just signing a 25% increase in food stamps, just, the biggest increase in the history of the program. That's already happened. And we have this whole laundry list of spending programs that's, on deck with the Democratic Congress. There is no way to fund this spending by raising taxes on the rich. And since they don't want to officially raise taxes on anybody who's not rich, the only way they're going to tax the people who aren't rich is through inflation. And so the deficits are going to get much bigger. The quantitative easing is going to get much bigger. And so then the people who are investing in gold stocks, instead of pricing gold stocks to reflect a lower gold price in the future, maybe people are assuming gold's going to go down to 1,500 or 1,200. I don't know where they think it's going to go. But when they have to start looking at these stocks through a whole new prism of, hey, gold's going higher. It's going to go to 2,000. It's going to go to 3,000. It's going to go to 5,000. That means the profits of these gold mining stocks are going to soar. And in fact, if you look at gold mining stocks right now, they're already trading. The major gold mining stocks are trading at a discount to the S&P. They're actually on a lower price earnings ratio than the S&P, even though historically they trade at a big premium. And once you actually get this big increase in gold prices, those PEs collapse unless the prices really go up. And some of the gold stocks are already paying pretty decent dividends now, and those dividends are going to end up much, much higher once the gold price rises and their profits rise. So in my final minutes here, I think the best way, again, to profit from the fact that gold hasn't rallied yet and that these gold stocks reflect fantasy, not reality. They reflect the fact that so many traders don't understand the predicament that the Federal Reserve is currently in, is to buy these gold stocks now. You know, we run a gold fund, the Euro-Pacific Gold Fund. You can buy that fund through Euro-Pacific Asset Management, Euro-Pacific Capital. We also have the funds available if you happen to have an account at a discount broker. It's available there. We also have separately managed accounts where we manage portfolios. Adrian Day is a portfolio manager, and we manage individual portfolios with gold mining stocks. And I think the ones that offer the most potential are going to be some of these junior mining stocks. It's easy to buy some of the senior companies, but the hard part is to figure out which of the juniors have all the potential, because there's a lot of pitfalls there, and you need to know enough to avoid those and to maximize your exposure to the ones that have the most potential. I don't know, can you hear that noise? Oh, all right, stop. Hello?
I cannot, if you're asking me.
Okay, good. Yeah, there was a timer and it was ringing in my ear. I didn't know if you guys heard it. All right. But the timer was telling me it was my 30 minutes was up. But I don't know if there's any questions to take. You said I was the last speaker, so I don't know if there's any questions.
You are, and you have a lot of people saying, thank you, Peter. Thank you, Peter. What a great ending to the show. We'll definitely ask a few questions. Great presentation, by the way. So Vor asks, still no love for crypto, not even a little bit.
I think that, crypto is just another one of these bubbles that the Fed has succeeded in inflating. I think all of the money going into crypto-related industries is going to turn out to be malinvestment, and a lot of these companies are going to go bankrupt, and a lot of investors are going to lose a lot of money. I know people have made a lot of money in crypto. The ones who have sold have actually made money. The ones who have not think they've made money. They've made money on paper. But the key is, will they actually have any real profits when the bubble pops? I don't think so. I think if you sell and leave the casino a winner, then you did better than I did. But if you stick around long enough, you're going to lose all your money. So I would take the money and run if I had any.
All right. Matthew asks, could you comment on the spike in reverse repo activities?
Yeah, again, this is an indication that there's just too much money out there, that the Fed is creating too much money, and the banks. There are no loans that are worth making at these low interest rates. They want to park the money with the Fed. They don't want to take risk. And so, the Fed is having to, be active more and more in the market based on how much they've already corrupted the market and how much it's oversupplied with dollars relative to the legitimate needs of the economy.
Brian asks, what is your criteria when you would have to abandon your gold support?
Well, my criteria for that? Well, I guess if the price of gold really got expensive, if it went way up and I thought it was overpriced, or, if other assets crashed, to the point that they were so underpriced relative to gold, which basically is the same situation. But then I would want to use my gold to buy more stocks or to buy more real estate. But right now I want to have an allocation to gold because I do want to have some dry powder. And, I don't want to keep my dry powder in fiat currencies because the powder might be worthless when I want to deploy it. But I know gold will retain its purchasing power. And so I do want to hold that as a store of value. But if the question is related to crypto, is there something, because a lot of people think, well, crypto has replaced gold. No, it hasn't. It's only replaced gold in the eyes of people who don't understand gold. You have a lot of young kids who have never owned any gold and, who don't have very much investment experience at all, who are attracted to Bitcoin. But after they get burned, they'll learn a very valuable lesson. And maybe as they get older, they'll discover gold too. But most of the people who have historically understood gold and gold's role as money and gold's value as a commodity and as a store of value, they haven't given up on gold. They still have their gold. It's people that never owned any gold that are on the crypto bandwagon.
Great. Gerard asks, what is your opinion on copper?
Well, the price of copper is going to go up. The price of all commodities are going to go up, but a lot of that is not commodity prices going up. It is the value of paper going down. So if the dollar loses value, you need more dollars to buy copper. But another reason I like copper and nickel for that matter is I do see the trend towards electric vehicles. And I think that trend is going to continue to grow over time. And to the extent that we're going to have more electric vehicles, we're going to need more copper. And we're going to need more nickel. And so I think that those metals in particular are going to benefit as we move away from combustion engines, gas-powered engines. We're not going to abandon them anytime soon, but we're certainly going to have more and more electric vehicles on the road, and they're going to need more copper. And I think we're going to need copper in other areas. I think the emerging market economies, I'm particularly bullish on those economies once the dollar crashes. And so those economies are going to be consuming a lot more copper. So the demand in places like China or India is going to go way up, and it's going to more than offset the decrease in demand coming from the US.
All right, H says, or asks, some economists and some presenters at the Money Show assume Fed tightening is coming. What do you think about conditions under which the Fed will actually increase interest rates a lot?
Well, I don't think there are any conditions that it would increase interest rates a lot. The question is, will it increase interest rates at all? And I don't think they will in this cycle. I think the only thing that will force the Fed to raise rates will be a dollar crisis. So once the dollar is really in free fall, then they may raise rates, and then they may raise them a lot. But, the question is, will a lot be enough? Will they raise them enough to make a difference? Because let's say inflation gets to 20% before they raise rates from zero. Where are you going to raise them? You can't go from 0 to 1% and expect to do anything about 20% inflation. If inflation is 20%, you got to make rates maybe 25%. But can the Fed do that? Even if they wanted to do that, everything would implode. All the banks would fail. The government would have to default on its debt. What would happen in that environment? The Fed has put us in a situation where we're damned if they do and we're damned if they don't. There's nothing that they can do that doesn't end in catastrophe, which is why I think they'll just opt for having the catastrophe later rather than sooner, even if the catastrophe that we have later is even more catastrophic than the one that would come if we had it sooner.
Leslie asks, which metal, gold or silver, will go higher?
Well, percentage-wise, if I'm right about what's going to happen to the price of gold, according to history, if we follow that, silver would make the bigger move. That's typically what happens in bull markets, is that silver outperforms gold. And if you look at how cheap silver is right now relative to gold, I would assume that the same thing would happen again. There's no guarantees. Maybe it's different this time. I don't know. But if it's the same this time, which is normally the case, you would expect a bigger move from silver than gold. And that is what I expect.
Right. And Linda asks, which stocks do you specifically recommend?
Well, again, I don't give out specific stock recommendations, but I do recommend my funds, and then, and the reason I don't do it has to do with FINRA rules on knowing your customers and making recommendations. But, I generally don't think that people should just buy a couple of stocks, especially when it comes to gold mining. There are a lot of gold mining companies, especially in the junior sector, exploration sector, that could go to zero. I mean, they don't have any gold and they may never find any. So even if gold goes way up, you could buy those stocks and you could lose all your money. So it's best to hire a professional who really knows the industry and is on top of it, knows the management teams, the projects, and can really evaluate which of the speculative stocks you want to bet on and which ones that you want to avoid, and mix that into a portfolio that has some of the senior producers, some of the mid-tier producers. So you really get a good balanced exposure to the sector. And you can get that in the Euro Pacific Gold Fund. You can also get that by having a separately managed account managed by Adrian Day through Euro Pacific Asset Management.
All right. And we can end on this one, if that sounds okay. Thank you for the extra 10 minutes of your time. But
sure, no problem.
Thank you. Brian asks, what is your opinion of Jim Rickards and his views on the economy?
Well, I don't know all of Jim Rickards' views on the economy. I mean, I'm somewhat familiar because I have heard him speak. And on many things that we agree. I mean, we both talk about a much higher gold price and a much lower dollar. And, I think a lot of his views are grounded in Austrian economics, the same as mine. So there are a lot of things, where we see eye to eye. I know there are things I forget where we have differences. I know I did have an argument with him at one point over the definition of inflation. He defines inflation as rising prices, and I still define it the old-fashioned way as expansion of the money supply. But, there may be some other things that we're not identical, but I'm sure we agree on far more things than we disagree.
All right, Peter, that was a fantastic presentation. You have multiple attendees saying, thank you, Peter. We appreciate it so much. So there are additional questions. What is the best way for them to get a hold of you? Do you want to tell them your website, or what's the best way for them to contact you and your team?
Well, again, go to the website. You can see the website above my shoulder for the asset management company, europacfunds.com. Also, europac.com for the broker-dealer, Euro Pacific, to talk with our representatives about our strategies, about my mutual funds. So, you can contact us directly there. As I said, if you have an account at Fidelity or Schwab or any of these discount brokers, if you just want to buy my mutual funds, they're there. You could buy them. But I prefer that you work directly with our representatives. They can really help tailor your portfolio, get the funds that are most suitable for you. And if you don't want to be in a mutual fund, if you want to have a portfolio of individual stocks and have us manage it, you can do that. Or you can work one-on-one with a broker, and he can help you build and manage your own portfolio and give you access to all the markets around the world. A lot of firms just focus on the US, but you really need to avoid the US, and you need to look abroad if you want to escape this inflation tax and protect yourself from a dollar crisis. And of course, people should, follow me on social media, listen to my podcast. I do them, usually 2 or 3 times a week, depending on my schedule. But you can go to schiffradio.com, listen on my YouTube channel, The Peter Schiff Show. So follow me on Twitter. I'm on Facebook. I'm on Instagram. I'm on, YouTube. All sorts of ways that you can, keep up with my thoughts and the markets and get a different perspective, because the conventional media sources give you a very skewed and biased perspective of what's going on. I think I cut through the BS and tell it like it is.
And that's why you're a Money Show favorite, fan favorite. Thank you so much for your time and the bonus time and answering those questions. Okay. We really appreciate it.
All right, take care.
You too. Bye-bye. Thank you.